Is there a best time to invest? Can I time the stock market? Is it possible to predict when the next crash is going to be? Wait, I should just invest a certain amount no matter what the markets are doing. Ah, there you go, Timmy. Now we're getting somewhere. What's going on, everyone? My name is Ash, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today, I want to address the universal question, when is the best time to invest? And in short, there is theoretically no best time. But to answer this question indirectly, and mainly what this video is about, is dollar cost averaging. That is your solution, because in reality, it is impossible to time the markets. And dollar cost averaging allows you to consistently build up your market exposure while allowing you to have multiple entry points. So basically, if you have a lump sum of money, not putting the entire amount in at the same time, rather spreading that amount over a number of different months to account for the market fluctuations that we're all too familiar with. Today, I'm going to give you a real life example of how powerful dollar cost averaging can be. And I'm going to use the year 2020 as an example. No, don't worry, 2020 was probably one of the best years to showcase how effective dollar cost averaging can be. That's probably all 2020 was good for, honestly. And it's because of the crazy fluctuations we saw, aka volatility. Before I break this example down, dollar cost averaging is effective whether you have a lump sum you want to invest, or if you just want to invest a portion of your paycheck periodically. For my example, I'm going to be using a hypothetical $6,000 investment into this fund. This is a basic S&P 500 index fund. And to illustrate how dollar cost averaging works, I'll be showing how a monthly $500 deposit in 2020 would drastically affect your total return versus just depositing that same $6,000 in the beginning of the year. So to start things off, just to get it out of the way, let's start with the lump sum. If you invested all $6,000 into this fund at the beginning of January 2020, assuming it was the first trading day of the year, you would have bought this index fund at $49.81. This is what's called your cost basis per share, and you would have bought close to 120 shares. And at the end of December, your investment would have increased to $57.42 per share, with a total ending balance north of $6,900. That's about a 15% return. That's not bad. Actually, that's an incredible return. But let's see how our return would have differed if we would have used dollar cost averaging. Remember, dollar cost averaging is spreading that same $6,000 over a number of different months. For this example, we're going to assume that we deposited $500 at the beginning of each month into the same fund. That would end up equaling our $6,000 principal. When dollar cost averaging, or even investing for that matter, it's important to understand that each transaction is its own, meaning that each transaction will differ in the price per share and also the number of shares that you buy. And it's because, of course, the stock price is fluctuating. Here's a chart that shows just how much that particular index fund fluctuated during 2020. You can see that drastic dip that occurred in March when the pandemic and shelter in place was declared. And the amazing thing about dollar cost averaging is that we're able to buy at some of these really low entry points. This ultimately helps with our cost basis and total return. Let me demonstrate. So here's a breakdown of all the actual prices per share and number of shares we would have bought if we dollar cost averaged into this fund for all of 2020. You can see that since we have 12 different entry points into this index fund, we're able to buy more shares than if we didn't dollar cost average. And when the stock price goes up, more shares equals more investment. In other words, more monies. When we do the math, the number of shares that we own is a little over 123, and that brings our total dollar amount of investment to $7,081.03. And really quick, remember what the price per share of the lump sum transaction was? Well, when we do the math, our price per share when dollar cost averaging is less, which ultimately enabled us to buy more shares. So when compared to the lump sum, our return is 18% higher by dollar cost averaging. Amazing! That there is the reason why dollar cost averaging gets its name. It's basically the average cost basis of all the shares that you have purchased in a given time period. And the average tends to give you a much more smoother ride than just one entry point. So the more entry points that you have, theoretically, the smoother the ride. That's why dollar cost averaging makes a lot of sense, because when spread out over a given time period, it takes the volatility factor out of the equation for long-term investors. Other benefits of dollar cost averaging include reduced anxiety of trying to time the markets, peace of mind knowing that you are going to invest at a set day every month regardless of market noise, reduced emotional decisions when it comes to investing, and it allows you to keep long-term focus. Remember, investing isn't a sprint, it's a marathon, and you should be more focused on your time in the market rather than timing the market. Before we depart on this segment, here are some tips on how you can dollar cost average more efficiently. Number 1, pre-identify your investments and set a reoccurring day to invest. Whether it's an index fund or several stocks, know what you are going to be investing in and when. So that way you don't have anything standing in your way when you do decide to dollar cost average. And you make the process smooth and expedited without much thought process. Number 2, automate a portion of your direct deposit into your investment accounts. So that way, every paycheck you have money go directly into your investment account and is readily available for you to transact on. Lastly, ignore the noise. Whether it's friends, family, or CNBC, the reality is there is always going to be a reason not to invest. Whether it's political risk, new laws, market headlines, you cannot allow the short-term events affect your long-term objectives. Stick to your strategy, maintain a long-term view, and you should be just fine. I hope this video gave you a better idea of how dollar cost averaging works and how it can be beneficial for your investment strategy. If it did, be sure to hit that like button and also share with those that you think might find this information useful. I'm bringing weekly videos on personal wealth management and market insights, so be sure to tap into the comments on topics that you would like to see me discuss in a future segment. I would love to hear what is trending and top of mind for you. I appreciate you all tapping in. My name is Ash. I'll catch you guys next time.